Hello and welcome back to Stock Market Weekly. I'm your host Evan Medeiros, and we had another, busy week, but not a whole lot has changed from the structure of the market. Still a very busy wartime sort of headline-driven market. We have indices all closing at fresh lows for the year going into the weekend. We've got the VIX elevated once again. We've got oil spiking back up around 100. And so the chop continues, the uncertainty continues. We had some late headlines on Friday with sort of Trump administration versus Powell and some of the courts there favoring in Powell's favor. So there's a lot going on. Let's get into it here. We're going to look at a lot of individual trade ideas and some of the themes that we've been talking about in recent weeks. Let's get into it here. Our sponsor of this show is Investors Business Daily. We have two links in the description of this show once you get done watching. Check them out, claim those discounts, check out Market Surge this weekend. So front and center here, of course, is just the extension, the fog of war, quite literally here, between the US and Iran. The situation here just doesn't really seem to have too much of an end in sight. Perhaps it's a week, perhaps it's a month, and markets hate uncertainty, and this is why we're getting this malaise, this drag, this volatility chop that continues to weigh on the market. Now, with oil prices spiking here and with a uncertain time of resolution, we now have the economists starting to come out and adjust the inflation concerns here. The fact that maybe the Fed cannot cut rates for the foreseeable future if we are going to sustain higher energy prices across the globe. And so we're starting to get these inflation adjustments here. And I think as it stands right now, the market is maybe consensus on just one rate cut for 2026. I think that's the highest probability scenario, which again is just very different than how we started the year. Financials. This here continues to be a very heavy spot. I think lots of eyeballs now on financials. They started the year again on this nice kind of rock star breakout type of trajectory. It's reversed. We've broke through support and we continue to slide lower here on Friday. I posted I guess I didn't include it, but basically the second worst, getting closer to the first largest drawdown in the last 3 years for financials. Just a handful of things going on here, but the private credit concerns that are happening, of course, what interest rates are doing in the economy, and just financial conditions generally speaking. So it's not good when you have financials continuing to hit new lows in the market. Now, a place that's not hitting new lows is energy, right? No surprise here. Oil is at $100 a barrel. XLE last week, though, trailed. There was a pretty good divergence. And so I think some of the read in here, and again, I'm not going to be, claim to be an energy expert here. I think we're all kind of catching up with energy really coming back into the scene here. It's not a new trend for us, though. It's something we talked about right at the beginning, right in here. Last year, even, I was taking some shots at energy longs in here and a little bit too early. But from a price action, perspective, this trend emerged many weeks ago. But as it stands now, when we kind of look at the relationship between XLE and USO, there's a clear lagging display here for XLE performance. Part of that is just perhaps the fact that crude oil is not suspected to be elevated at this level for an extended period of time, which is why you're maybe not getting in such an urgent boost here in XLE prices. Regardless of all that, if we're just studying price action here, which is going to be the best way between all the noise that's going on, it's still a very clean, orderly trend here for XLE. It's an underinvested spot, and it represents a tiny amount of the S&P 500, so I still like it. 2 weeks ago or 3 weeks ago, I basically made a video and spent a lot of time saying how much I dislike the Mag 7, as it was sort of one of my more bearish ideas. And we have the Mag 7 now sort of selling off to new lows going into the weekend here. Now, again, there's some individual stocks of the Mag 7 that could start to emerge. We'll talk about some of those a little bit later that I don't dislike as much. But generally speaking here, I mean, this is just a more bearish version, a little more of a bearish tilt than the QQQ, right? Let's just call it what it is. Meta was not helping on Friday. We did get a fresh breakdown here. Meta's been in a very tough spot now for some time, but it's, sort of getting back towards these recent lows. I think they had a delay on their AI model that they've been working on. And so, with the AI trade in general, I think lots of these stocks are priced for, I wouldn't say, maybe not perfection, that might be too strong of a word, but execution, right? We don't want to see delays in a already scrutinized sort of heavy capex environment. And so you're getting some delays and Wall Street's going to punish it. And of course, layer in a couple of other things, the weekend, geopolitics. It doesn't take much to spook some of the big Mag 7 stocks. Oracle reported earnings. This one's a little bit off the cycle, but it reported earnings this week. Good news is it's well off the lows, so we are now starting to at least price in a little bit of a sideways range here and not continue to cascade lower. So I think that is constructive here. Again, my stance on software, I'm just not as excited. I'm not interested in catching bounces or a big V-shaped recovery. Maybe it happens. And if that's your cup of tea, by all means, I hope, it works out for you. I just it feels like there's a lot of trapped money there. And I do think that there's going to be a lot of overhead supply. I've made this point multiple times now, but we could easily go sideways and Oracle's doing that right now. Okay, let's get into numbers. We're going to look at more charts later on. It was basically a red week across the board. There's not a whole lot of places to hide right now. It's frankly oil or dollars. I mean, that's kind of it. There's not or VIX, I guess. Those are kind of the only places that are really performing in hedging. You can see indices were red across the board. Oil was up 10%. This is the intra-week chart here of the S&P 500. Open them at the highs and basically sell, sell, sell. You can see again on the right-hand side, the S&P 500 just closed at fresh year-to-date lows. Here's the VIX, kind of the opposite as you might expect, going into the weekend here at the upper 20s. So this is, again, a place where people are hedged going into the weekend. We've got 2 days of markets being closed. We don't know what's going to happen. And so let's sell off stocks. Let's get protection. And as a reminder, this is the quarter. Is it quarterly? Yes, this is the big quarterly OPEX. I believe we're coming into, it has to be, right? It's the monthly, so it's got to be the quarterly here coming up. So it's a big one. In terms of dollar strength, so this is what has been hedging right now. And unfortunately, it's not really gold, but the US dollar is definitely strong here, moving back and up to the right. 10-year treasury yield. This is a sticking point here as well. So treasuries are not hedging either, right? So it's not a flight to safety into the bond market. You could look again at some of those interest rate cut expectations. If we don't think the Fed is going to get as many cuts as we originally did, then, almost by design, we have to price in a more expensive funding cost here. And so 10-year treasury yield, we were looking good for kind of a hot second below 4%. And here we are now 4.28. It's a very fast vertical ascent. Sector performance this week, it was just energy and utilities. That was kind of the only thing holding up. I will say technology, is as much kind of stress and bearishness as we've had on tech kind of coming into this year. It has been firming up a little bit here just recently. It was down on the week, but still outperformed. Financials were the hardest hit at 3.34%. Now, if we take a look at our trade risk smart trend filter, this is available on our website for download. Energy, this is it in terms of the confirmed sort of bullish state here. Just energy. On the middle list here, utilities technically are still on a buy signal, and communication services are rolling over. So there's not a whole lot there. And then there's a whole lot of kind of confirmed negative bearish. So breadth here is now weakening. It's getting more, difficult to find pockets of strength here. Here's the 52-week high and low list. You can see that there's been a dramatic dry up in the number of stocks hitting 52-week highs. So for, again, a couple of weeks here as the war kind of broke out, we were still doing okay. The saving grace so far is that the 52-week lows isn't quite expanding, but it looks like it could, right? So we are getting more stocks hitting 52-week highs than we are more stocks hitting 52-week lows than we are hitting 52-week highs. Now, again, for the contrarians out there, here's a positive for you. Percentage of S&P 500 stocks above a 20 SMA. We're falling off a cliff. So there's a lot of pain out there now in the S&P 500. There's a lot of oversold stocks, I guess I should say. Oversold can easily become more oversold. It's not a reason by itself to be a contrarian, but it shows you that you do have a market that is sort of washing out here. And so that's something we can be on alert of. One of the things I talked about last week, and I still believe it this week, I think if we think about where the surprises can come from in this market, I do still believe that upside surprise is something that could ignite this market a lot more than just a sudden downside. There's risks on both sides here. Don't want to diminish risks, but I do think with everyone kind of hedging, with everyone knowing what the fear and uncertainty is right now, a lot of it is, kind of pricing in, all right? And it's not a call that we can't go lower. I just think on the margin, if you got a bout of good news, the market can, swing. Don't have too much to say about the put to call ratio. Hasn't really, we had a brief kind of spike up here. This is, again, all data as of Thursday. This is not Friday's data on those two charts. Positive here for Bitcoin. So, as you've kind of got the NASDAQ 100 that's like rolling over and the S&P 500 that's rolling over. Well, you don't quite have the exact inverse, but you do sort of have a potential kind of bottoming relative strength building here for Bitcoin. I will say, Bitcoin was the first to break down or to do it pretty heavy in this, beginning of the year, let's call it. And even before that, obviously. But now it seems like it's starting to catch its footing. If we get a big risk off, kind of negative catalyst that starts to accelerate, don't hold your breath of Bitcoin being able to sustain this. But if the market can, just kind of chop around, maybe when I say market S&P 500, if it just kind of chops or maybe slowly goes down, maybe you do get some relative strength building here and working to kind of higher highs. So Bitcoin, something that I think is interesting, and we'll look at some of those stocks as well. Next week, we got the Fed. The Fed is out on their latest FOMC. We do not expect any rate cuts, so it seems largely status quo that things will be kept the same. But of course, what do those future comments look like, and what are they saying about the recent spike in energy costs? All right, so we're going to jump into some charts here. Stick around. All right, we've got some charts in front of us. S&P 500, this is Warden TC 2000, and this is a weekly chart. So each bar represents 1 week worth of trading. S&P was down 1.6% this week, and it is rolling. We are definitively below that 6,800 band that we were looking as kind of an upper level of support. So the market is rolling over. It did that last week, but now we've got a confirmed kind of follow through week lower. Big range this week. So look at the tail up here as well. And if we just zoom out and try and get some perspective before we go into the shorter term action, we have lows from October and November that we tested down here around 65 and change. So it seems like the S&P 500 needs to come back down and test those levels again. It's only 2%, 1.3%. So, I would largely expect that to be taking place next week. And we'd want to see that hold, because this now is kind of the bigger elephant in the room of support. Because if this gives way, then we really have to start zooming out much further. And the biggest relevant context level that I would be paying attention to if that 6,500 range doesn't hold would be the old highs here from the breakout in January, or the highs from January, but the breakout that took underway coming out of the tariff tantrum last year in June. So that comes in around 6,100. Now, again, this is a weekly chart. This is zoomed out. This goes back multiple months. But if you really just give it perspective here, even if we did get to that scenario, you're talking about a 12% correction here in the S&P 500, which, in any given year is pretty ordinary. It doesn't have to take a massive amount of, uncertainty to get a 10% correction, especially and again, even in a secular bull market. So really, this on a bigger perspective is all still kind of healthy things, I think. Just, as wild as that sounds, it really doesn't have to be the end of the world if the S&P 500 corrects 10 or 15%. Now, again, that's not a claim that we're going down there. Again, we have levels to look to. And again, namely, this would be around the 6,500 area where price found support late last year. So let's take it one day at a time. I do think, testing this would be an easy target for next week. And then looking for those dip buyers to show up and just make themselves known that they are finding value in this market. That's what we're looking for here. We have now, traded all the way back to levels that we were at in fall time last year. So the S&P 500 was around this same 6,600 level September of 2025. So this has been a very stagnating market from an index perspective. If we look at the QQQ, notice we did talk about a little more technology relative strength this week, and we're right at our critical kind of level that we've been talking about these past few weeks, right into this 590 area. We did close at the lowest level for the year, but we are still, again, going back to September, fall time of 25, we're back to this area, and this is a more defined sort of top or just support area, this sideways band that the QQQ has been in. We did briefly get down around 583 here. So we've held this level, and we're going to want to pay attention to that, next week. Big picture perspective, that breakout equivalent for the S&P 500 would be around 540. And if we did roll over here, that is a pretty ugly looking potential top. So let's be aware that things can roll and get pretty spicy below 585 or so in the Qs and below this 650 area in the S&P 500, but we're not there yet. So let's take it 1 week at a time. Look at the weekly bars here though for the Qs. Again, just lots of overlap, lots of energy built up. And so we want to be aware of that, right? It's a good time to manage risk. It's a good time to understand positioning. This is a place where you need to pay attention, right? Like, I think fundamentally we can get a sharp move here in both directions. And that should almost be the expected default base case here. So let's keep an open mind of where this market wants to go. So far, it's just a slow bleed downward. Russell 2000 has been bleeding and is in just a more sort of defined kind of short-term trend lower, right? Let's take a look at the VIX. So VIX this week going out close to 30. That shows that there's lots of protection. There's lots of fear. So just, again, think about positioning. Think about the potential catalyst that can come in here and, have your shopping list ready. I mentioned that last week, but I think these are the times where if you've been waiting for stocks to pull back to certain levels, if you're more of an investor and you've got some names that you've been waiting on, this is the time to kind of pull out that list, dust it off, know the levels, get those limit orders ready. You don't want to be reactionary in the moment if you do have some kind of spike down and you only get a morning to get some fills. before a market reverses or, some type of fast action. So get your shopping list ready. We'll look through some individual names here in just a moment. Oil. So this again is really the best hedge now for a portfolio. Kind of saying that tongue in cheek, but not really. Closing up around 120 here in the USO ETF. And it is seeing a lot of volatility for good reason. I don't think I need to say too much more about that. XLE we sort of already talked about. MAGs we talked about. So this is the MAG 7 making a new year-to-date close. It is down 9% this year. So again, this is the MAGS ETF. And then here's software. So finally taking a little bit of a breather this week. It was down 4.46%. I mean, honestly, it doesn't look terrible. It looks like a well-deserved rest after a 16% pop off the lows. Again, I'm still bearish on this market broader, but I think we could easily still put in some type of higher low here around $82 and make a run towards the lower to mid 90s. And, still I would maintain a bearish longer term disposition there unless I just see other things changing. But IGV held in there, Oracle gap filled. So weekly chart still up 1.24%. So some relative outperformance, big volume. Again, I think if this can hang in here on these lows, you have tradable stocks to work with here, even in the software space. Let's look at hardware. Let's look at semis. SMH this week was up 1.7%. They led on the way down last week. We had a loud kind of bullish engulfing bar on Monday with some heavy volume, and that set the tone for the week. We topped out around Wednesday and then we pulled back late. So semis is still a place that I like. I want to have more exposure here, so I'm paying attention to it. I don't quite think it's a bargain yet. I'm not seeing a total, super attractive price, but I'd be paying attention to it. Nvidia, kind of the same thing. Both of these. Nvidia is interesting to me. I just want to see it cheaper at the lower end of this range, or maybe even some undercut of this range. I would love to, look at some either option trades there or some spot exposure. We already talked about Bitcoin, IBIT. We'll look at the ETF here from BlackRock. It was up 5% this week. So again, some relative outperformance, and it outperformed last week as well. So it should be worth noting that it's stabilized. It's kind of clawing itself off these lows. Maybe the worst is behind us. Again, if you got a very market-wide cascade risk-off event, it's not going to be immune. Expect selling, expect lower prices. Barring that, a slow drip lower in equities, there could be some more opportunity here on the Bitcoin trade. Meta, we talked about breaking down, looks pretty messy here. Amazon looks pretty terrible. Nvidia, we mentioned, I do like it. I like it at lower prices, bottom of the range, but that could be interesting. I think Apple is an interesting one that would be on my short list as well. Not at these prices. This looks like a fresh breakdown, but I would be paying attention to it down around 240s would start to get interesting to me. I don't have a position. I haven't had a position in Apple in a very long time. And Tesla, again, I want to like it this year, but it's still not giving too much. It had some good relative strength to start the week, but then it gave it all back. Well-defined, sort of orderly downtrend here. I like the structure. It's interesting. It's on my list. I've got like a token placeholder position, but no actual size to it. I want to add size to it, but I need more evidence that it's smart to. So I think that's everything there. Let's take a look at our two trading systems here. So we have our all-weather portfolio, Galahad. We have our momentum model, Quant Rockets. Here's the members dashboard. This is updated for Friday. So Galahad, let's see, over the past 5 days, looks like it's trailing a little bit here, but it's still kicking butt on the year. It's still up positive year to date. I don't know what the final latest number is, but relative to our S&P 500 benchmark, it's doing everything we want it to. So it's still kind of kicking butt and having a good year. For Quant Rockets, this has been going through lots of signals. There's exits, there's rotations, there's losses, there's wins. It's really being active. and I want to show you a few of the names. So Circle is the first one here. So this is our chart book page, which shows our entry prices, our current exit zones, our next targets, and it has more data down here as well. But Circle was a name that I highlighted a week or two ago, right at entry. I believe it was on Stock Market Weekly. If not, I know it was in our newsletter. But this has surprisingly worked very well. Again, I say surprisingly because I had my doubts on this signal, but crypto and these crypto adjacent equities have been working recently. And so Circle, while is no bargain right now, I did want to just highlight it as a bit of a trade update, but also to highlight the theme that crypto and some of these other names are starting to work. Cloudflare is probably my favorite of the software stocks. I've mentioned it online before. We got a signal last week for Cloudflare. So of course I was eager to jump on it because I finally had a model that said it's okay to buy Cloudflare. And so I did. And so I am long this trade. It's working. It's extended right now, but pay attention to it. If this can, consolidate, if this can offer some type of, second entry here, this could be an interesting one. Nebius has been love-hate one on our Quant Rockets model because we did have a trade in here like 3 weeks ago that ended up whipsawing us out. We took a 10% loss. We're back into Nebius now. As of this week, after it broke out, or its attempt to break out. So this one I think is interesting. If it can sustain some momentum here, you've got a breakout structure and this one can run quick. So I'm pointing this out for anyone that's looking at more the AI infrastructure kind of build out plays again. And last but not least is USAR. So this one here is a recent entry. So as of today, or yesterday's signal, this morning we purchased it. $20.06 was the entry, and our exit zone currently, this updates every day, so unless you're a subscriber, you're not going to see the updated exit zones. But right now our rough exit zones around $18. First target's up around 23. I like the potential structure here. This is basic materials, sort of rare earths play. And so, again, this is much different than mags. This is much different than S&P 500 exposure. When you start to go under the hood and you start to pick some of these individual stocks, it is a stock picker's market. That is what's good about the current environment we find ourselves in. But it's also a choppy headline, narrative driven market. And so you also have to just keep that in mind. So that's all I got. We went a lot longer than I thought I would, but hopefully this video was helpful. We've got links in the description of this show to our trading systems, to our sponsor. Thanks as always for tuning in every single week. And I hope to see you back here next Friday. Take care and have a great weekend.